Managing Director of Institutional Equities at Spark Capital, is with us now. Ganesh, good morning. Good afternoon, sorry. Good to have you on the show. I'm reading a report. You're saying that you turned positive on macros for the first time since September 2013 and are recommending buying non-defensive stocks. Okay.
Getting wary on the macros for the first time.
Getting wary on the macro. Okay,
yeah.
I think
for the first time since 2013, we are seeing clouds emerge.
Okay.
Late 2013 was the first time we turned positive for a couple of years. The clouds are appearing for the first time, and they are in the form of the trade deficit looking a little shaky, the non-oil, non-gold trade deficit looking a little shaky. Gold imports have gone up a bit. So the Indian remittances have slowed down. So the rupee's fundamentals are looking a little weak, and that's one. Second is the fiscal side. Center and state finances for the first time since then are showing some signs of weakness. And inflation trajectory is very misleading. We think it's a bit of a complacency that's emerging there, which we don't fully agree. And there are moving parts there which we need to keep an eye out on. So it's more a flagging of some of our first signs of concerns, and than asking investors to change their portfolio construct. It's really not really about getting very negative. It's more about keeping an eye out on some of the moving parts, changing direction.
So what does that translate into in terms of an index call? We've already lost about 200 points from top. So does that price in some of the concerns you raised?
Not much. Actually, none of these concerns are really something which market is fully worried about today. It's the first 2-3 months. We are keeping an eye out on this. We think if it continues for another 2-3 more months, the decibel levels on this will increase. That's something that at that stage we'll get a little more negative on. We'll ask clients to start positioning their portfolios a little differently, but not for now. We still hold on to our positive views and positioning, asking our clients to position their portfolios accordingly.
Okay, I'm looking at the list, and what really stands out for me is that you have exposure to almost all the private sector banks, including the second rung and third rung. I may want to add, even City Union Bank, Federal Bank, of course, we all know. What's going right for this particular space? These are old banks; these are not really your new banks.
2-3 things there. Credit growth recovery is something that we are beginning to see. When inflation inches up, typically loan books grow faster because that inflation fuels loan book recovery, growth recovery. NPA recovery, the medium-sized corporates have seen the squeeze on a credit front. That should improve, and this pack is still attractive on valuations. And they've all now become a couple of $1 billion to slightly even more on value on market cap. So they have come into the radar of the global investors. And that pack is amongst the banks actually offers the maximum upside.
I believe you still have positions on some of the big IT names like Infosys. What do you expect in Q1?
Valuations are comforting, point number one. We think the business models of some of these companies, it's not going to be, value creation will not be in growth, but more in cash flows, internal controls in terms of their billing models or costs, even capex. So free cash generation will actually improve. The valuations are actually quite attractive. And if the rupee's fundamentals weaken, seeing the way the rupee is valued on real effective exchange rate, which is really overvalued, and if the fundamentals weaken on the rupee could underperform. And after 3.5 years of appreciation, you could see some signs of depreciation, and that's big upside for the IT companies.
But just to follow up on that, is the market going to start looking at IT that way? Because the market's been chasing growth, and that's not come through for IT, which is why the derating. Cash, isn't that pretty much a known factor, which has been around all the time?
At certain phases, things change. If growth is coming elsewhere, market prefer that. But if growth starts to get a little weaker elsewhere, the flight to safety starts. Instead of trying to, so we had almost a 24-month underweight call on IT and played out. Today we think it's too risky to be heavily underweight. Still underweight, but we have reduced it quite substantially at this point in time.
Okay. Final question from my end. I also see a lot of cement and construction stocks in your portfolio.
State and central government spend has possibly been the single biggest driver. in the last almost 18 months, maybe even 24 months. The orders which the central government and state governments have given out will start showing up as earnings, as activity on the ground. When we speak to construction equipment manufacturers or construction financiers, we are seeing the first signs of demand picking up there. That will show up as earnings and growth delta for construction stocks. These are basically government spend beneficiaries. Those will continue to see the tailwinds as long as the fiscal doesn't go out of whack, which possibly isn't the case for next 12 months, but beyond that maybe.
Okay, okay, Ganesham, thanks a lot for